Have you hit a wall trying to qualify for a mortgage because your debt to income ratio is too high, or you can't provide some of the paperwork that lenders seem to want? If so, this video is here to help. In it, I'm going to give you an overview of lending options that use alternative income documentation. And one of these could be the missing link between you and a loan to buy a home that you know you can afford if only a lender would give you a chance. Now, there are 3 categories of alternative documentation programs, and then if everything else fails, there's a 4th option that's kind of off in its own orbit in a category all its own. They offer paths to streamline documentation, in some cases avoid documentation, and to create qualifying income from non-traditional sources. These are outside-the-box options that might be a better way to assess your qualifications for a loan if you're self-employed, if you're freelance, or if you have sources of income that are unusual, quirky, a little hard to paper trail. My intention for this video is to be more of an overview. I want it to be helpful and to plant seeds and to maybe give you some hope if you feel like you've been just repeatedly banging your head against a wall trying to get approved for a mortgage. I'll put some energy into creating some deeper dives that are a follow-up to this video. And as I record each one, I'll add links in the caption so that you can find more detail. I'll create kind of an index where you can look further into anything that sounds like an interesting strategy that might fit your needs. So please like this video, subscribe to my channel, and don't forget to turn on notifications so you know when I post this new content. And as a reminder, I'm a lender, so if you find my videos informative and helpful, imagine how helpful and informative I could be in person. You can call or text anytime. Now, one last bit of housekeeping is necessary. I kind of feel like it's important to take a second to address an elephant in the room. Does talk of alternative income documentation sound sketchy and have you flashing back to some of those scenes in The Big Short where sleazy lenders were talking about ninja loans? So I started in lending in 1994. So I was around for the wind up to the housing crisis and the crash and the aftermath to the crash. And for historical accuracy, I do feel compelled to mention that there never was a loan called Ninja. There were loans called Nina, which stood for no income and no assets, but Ninja was never a thing. But suffice it to say that a whole lot of loans were made with little or no paperwork and without thinking about the borrower's actual capacity to repay these loans that were being made. And we all know how that story ended, and in the wake of that terrible time, Congress decided that the mortgage industry needed some regulatory guardrails. Makes sense. And the most important one of these, for purposes of this video, is called the ability to repay, or ATR rule. Under ATR, it's actually illegal for a lender to offer a loan without putting reasonable effort into verifying that the borrower has the ability to repay the mortgage. But the ATR rules have a lot of latitude in them as to exactly how lenders are going to satisfy this requirement, and lenders have gotten, as you'll see with some of what I talk about here coming up, pretty creative. Now, in broad strokes, there are 4 flavors of alternative documentation loans. There are loans designed for self-employed borrowers, and I'll put freelancers in that category too. Loans for folks who are long on assets, have a lot of assets, but not long short on traditionally documentable income. Loans for income properties. And then this 4th option that I've hinted about, which I'm just going to come back to because it's really a little bit of a rule breaker and falls into its own category in a sense. Now, as I talk through each option, I'm probably going to hit topics that are just not applicable at all to your situation. So use the links in the caption or in the timeline to jump ahead to something more relevant if I hit a patch of information that just isn't interesting to you. But let's get started. So if you're self-employed, I want to start talking about the options that would be applicable for your circumstances. And I have to say, for starters, I'm a little bit of the black sheep in my family. Basically, everybody but me is self-employed. So I am super familiar with the disconnect between what your budget probably feels like in the real world as a self-employed person versus how it looks on paper, and more importantly, how it looks on your income tax returns. And this video covers non-traditional documentation options. But if you're curious to know what it's in opposition to, what the traditional methods are that we're sort of working around with the options in this video, I do have you covered. The video linked above runs through how lenders calculate income for sole proprietors. And If you don't file a separate income tax return for your business, then that's you. And in this video linked above, I walk step by step through the process and the calculations if you file as an S corporation. And that's probably what you're doing if you're filing a separate tax return for your business. So check them out, and you'll know more by the end of watching them than most lenders do about how to correctly calculate your income. And if you're self-employed and you've been turned down for a loan, there is a chance that your lender just wasn't calculating your income accurately. But sometimes even a by-the-book, accurate, spot-on calculation using your tax returns isn't going to qualify you for the loan you want. So when that happens, the answer may be to just kick your tax returns to the curb and document your income using something else. And there are a few options. One of them, which is just dead simple, is to use your 1099s. Your 1099s are those forms that you get from your clients, from anybody who's paid you for contract work. If you're a freelancer and your clients send you 1099s, or you drive for Lyft or Uber, or you do other gig work, this can be a great option. We just add up your past year or two of 1099s, we subtract a percentage for business expenses, and the result is your qualifying income. Now, if you don't get 1099s, or if you don't get 1099s for all of your income, there are a couple of other options. One, if you use a CPA or another certified licensed tax professional to file your income tax returns, ask them if they'd be willing to generate a profit and loss statement for your business. They will probably say no. But if they're willing, the net income from their P&L can be used for loan qualifying at face value. But really and truly, the go-to, almost all we use alternative documentation program for most self-employed borrowers is a bank statement loan. We just go straight to the source and document your income using the actual cash flow through either a personal or business bank account. If you have a strong firewall between your business and your personal banking, and you regularly transfer money from one business account to one personal account, an average of those transfers over usually 12 or 24 months can be used as loan qualifying income. But if you only have one account that's kind of your everything account, has a mishmash of commingled business and personal transactions, or if you tend to let profits build up in your business account, which is pretty common, you let them build up, you don't kick everything over from your business account to your personal account, kind of pay yourself, then we're probably going to want to look at your business bank statements. And to calculate your income, we just add up all the deposits, again, usually over 12 or 24 months, deduct an expense factor, and an average monthly is what your income will be for loan qualifying. Now, this is a very simple idea that does get just a little more complex in execution, but it works best if you own at least 25% of your business has relatively consistent income streams. If you're making deposits into your business bank accounts on a at least monthly, pretty regular basis. Now, if you see a link up above, it'll take you to a video with all the nitty-gritty details about how bank statement loans actually work. If you don't see a video up above, feel free to comment below and either remind me to add the link or to get my butt in gear to record another video that has all the details and the mechanics of how these bank statement loans work. Because like I said, they are a little more complicated in execution than what I just described, and those details are important. And I do want to take one last quick note and say that if you have recently gone from being a W-2 employee to a 1099 contractor, or you've just become a partner in a law firm or an architecture firm or another professional practice, maybe a medical practice, you're probably being told that you have to wait a year or two to buy a home. And while that is true in the vast majority of loan guidelines, there are a limited number of programs that give lenders leeway to work with new self-employment. If, and this is the really kind of key important element here, you either have a contract that outlines the terms of your employment, or if you're a partner in a professional practice, you'll be receiving guaranteed payments as a partner. Now, I want to move on to the next family of alternative documentation options, and these could be what you're looking for if you're long on assets but short on traditionally documentable income. If you assume you won't qualify for a loan because you're retired or you're receiving income from a trust or you're living off of other accumulated assets, I totally understand the worry. I honestly field phone calls every day. I did today actually from someone saying, I'm retired, I don't have income anymore, I probably won't qualify for a mortgage. And I get it because earning a paycheck definitely feels different than drawing from assets. But if you're living on something and the something is a financial asset, there's a pretty good chance that we can use that something, that financial asset, to qualify for a mortgage. And there are a lot of strategies for leveraging assets to qualify for a mortgage, but we can kind of loosely group them into 4 approaches. 2 of them require that you are actively using the assets, and the other 2 just require that you have assets. Now, if you've been actively taking distributions from your assets to live on for a year or 2 or more, then a really simple option can be to just look backwards and average your last year or 2 of distributions. But we also have the option to set up new distributions from accounts that have just been hanging out there, or if you've been taking smaller distributions and need bigger ones to qualify, we can adjust the distribution that you've been taking as needed to qualify for a loan. Now, these 2 options really work best with funds that are in retirement accounts or trust accounts. And a fun fact, if you're sitting there thinking you have to be a Rockefeller to have a trust account, you don't. You can actually set up a trust for yourself using your own money, set up the trust, name yourself as the beneficiary and trustee, fund it with your own money, and you can set up distributions from that type of account for loan qualifying for certain loans. Now, the other 2 options only require that you have assets. You don't have to be taking any distributions from them. Now, one of these has us add up your qualifying assets that check certain boxes to meet the rules, and run them through a formula to convert your assets into income. And I'm putting air quotes around that because this is all done on paper. You don't have to be taking any money out of the accounts. We just create a number that we can use for loan qualifying through a formula. But another category of programs does something that's totally different, and in a way it's kind of simpler. Instead of creating income out of your assets and then using that income to calculate a traditional debt-to-income ratio, we just verify that you have a certain amount of total assets, and done. Now, the amount that you need for that type of loan depends on the amount you want to borrow and what your other financial obligations are. But if you have sufficient assets, then you're just automatically approved, and we don't bother taking the extra step of even calculating a debt-to-income ratio. Now, which one of these asset-based options is going to be the best for your particular situation is going to depend on the size of your down payment, the amount and type of assets that you have. Are they retirement? Are they trust? Are they in savings? Are they in brokerage? How long you've had them, and your age. And you can check the caption for links to videos with more detailed information, or in the future you'll be able to. I'll add them as I record them. Or again, you're welcome to nag me in the comments below. If you have a question about one of these options and I haven't added a video to it, comment below and I'll get around to recording that video sooner. And you can always just reach out to me directly. I'd be happy to help you find the best option for your particular circumstance. My contact information is already definitely in the caption, so you can get that there. Ready for our next category? So next we're going to talk about lending options for income producing properties. And these programs are going to vary a little bit depending on whether or not you do or plan to live in the property. Rental income that you receive from people who live with you in a single family residence is called boarder income. And although boarder income isn't widely used in lending, there are a few instances where it can come into play. And this is actually potentially going to change really soon. Boarder income may play a larger role in loan qualifying shortly. Currently, conventional loans allow boarder income for as much as 30% of your total qualifying income if you're disabled and you receive rent from a live-in aid, or if your total qualifying income isn't over 80% of the median income for the area in which you're buying. FHA loans allow border income if you've claimed the income on your past 2 years of income tax returns. But here's something fun and topical. FHA has just proposed, as I'm recording this, they're sort of taking comments at the moment, to change their rules to align more with conventional rules, where they'll allow up to 30% of your qualifying income to come from borders. You don't have to show it on your income tax returns. And the best part is with no income limit. So that's why I'm saying border income may actually become more relevant. And I will definitely be recording future videos with details on that. And it's also worth mentioning, just as an aside, if you're living in a house that has an accessory dwelling unit, an ADU, or you live in a duplex or a triplex or a fourplex, actual extra apartments, the rent that you receive from your tenants in those situations isn't considered border income. And it's more, that rent, the rent they pay to you, is more widely accepted and falls under different lending rules that are more universally acceptable. I guess I shouldn't say universally, but more widely accepted. Now, if the property you're looking to finance is purely an investment property, you're actually eligible for a pretty notable alternative documentation program called a debt service coverage ratio, or DSCR loan. And I say DSCR loan programs are notable because in general, residential loans are very borrower focused. We care about you and your income and your debts, and we qualify you based on your personal debt to income ratio. DSCR loans are property focused. They're so property focused that they don't actually require any information about your employment. We don't ask about your income, and we don't calculate a debt to income ratio. DSCR loans are, the way I kind of think of them, is as being a streamlined version of the loans that really big time investors use to finance huge commercial properties like high rises, apartment complexes, shopping malls, stuff like that. And if you think about it, if you were going to go buy a downtown high rise, it would be silly, kind of goofy to calculate a personal debt to income ratio. It isn't going to make sense. First of all, the payment's going to be huge. And second, you're not going to personally pay the mortgage. It's going to be paid out of the rents from the tenants in the building. So the ratio that lenders care about for these types of loans is the debt service ratio. Can the building carry the debt? And DSCR loans just let lenders apply this same logic to smaller residential properties, like a house or a duplex or a fourplex or a small mixed unit building or a small apartment building. And this makes qualifying for debt service coverage ratio loans so simple it's silly. If the rental income from the property is high enough to cover the mortgage payment, taxes, insurance, and any HOA dues, you're done. That's it. You qualify. And some of the more liberal DSCR programs are actually okay with a mortgage that is slightly more than the rent that the property is generating. Now, because we don't ask about income or employment, and we don't need tax returns, we also don't calculate a debt to income ratio. DSCR loans sometimes feel like a lending cheat code, but they're allowed because loans for business purposes, like buying an investment property, are exempt from ability to repay rules, that ATR rule I talked about before. And you actually have to sign something saying you're not going to live in the property at any point in order to qualify for a DSCR loan. Now, I want to talk about that fourth and final kind of rule-breaking category that I alluded to earlier, and these are loans that are based on your equity. Your equity is the difference between the value of a property and what you owe, and a little while ago you just heard me say it's illegal for lenders to make a loan without giving consideration to your ability to repay, and loans based on your equity aren't thinking about repayment. So this is why we're in a category that's all its own here. These are truly the exceptions to the rule, in this case, the rule being the ability to repay rule. Now, the first of these exceptional loans is reverse mortgages. And this is an exception that actually makes a lot of sense. Reverse mortgages are what are called non-recourse loans. If you take out a reverse mortgage, it's the equity in your home that'll pay the loan back at some point, someday. Your minimum monthly payment will always be zero. You can make a payment if you want to, but your minimum payment will be zero. And in fact, a lot of reverse mortgages are set up to pay you. They're designed to convert your home equity into cash or cash flow that you can spend on everyday expenses, on home improvements, on medical care, on fun stuff, trips, stuff for your kids, whatever, really anything that you want or need. To qualify for the most common reverse mortgage program, you do have to be 62 years old, but there are a couple of options that you become eligible for at age 55. And there is one other really important requirement, and that is a lot of home equity. If you don't have a lot of equity, reverse mortgage may not be an option for you. And then there's our final alternative documentation program, and it's something called a no-ratio loan. And as the name kind of hints, no-ratio programs don't require that lenders calculate a debt-to-income ratio. We don't ask about your employment. We don't ask about your income, and we don't need your income tax returns. No-ratio programs are based entirely on your down payment, your credit, and your reserves. And reserves are lender speak for money left over in savings after your loan closes, after closing. Now, these programs only exist because the U.S. Department of Treasury has given special status to certain financial institutions that focus their energies on serving low-income borrowers and communities with limited access to traditional financing. These types of institutions are called Community Development Financial Institutions, or CDFIs, and there are about 1,400, give or take, CDFIs around. Only a handful of them offer any kind of home loans, and at the moment, 2 of those offer these no-ratio loans. CDFIs are exempt from federal ability to repay rules. That's part of their charter. But some states don't recognize this exemption. So no-ratio loans aren't available everywhere. And there's another important thing to know about no-ratio loans, and that is that they're expensive. Most loan programs that let you color outside the lines in some way carry a little more risk for the lender. Whenever a lender feels like they're assuming extra risk, they usually charge a higher interest rate or more fees or a combination of the two to offset that risk. And that's definitely the case with no-ratio loans. Now, this video was intended to be a highlight reel, but I hope it's planted a seed or maybe given you hope that a no from one lender could turn into a yes from another one. And maybe I'm that lender. I work with every one of the loan programs that I've talked about in this video, and I'm licensed in all 50 states, and I would be more than happy to talk and see what I could do to help you out. Thanks so much for watching, and maybe we'll talk soon, and if not, I guess I'll see you in the next video.